Hey traders, Jason here from Lever Brothers. So I'm going to do an update of my State of the Market series. Essentially what has happened is January was a fantastic month. The market trended up. I guess you can go back before that and say the market trended up off its October low, had some weakness second half of December. January was a fantastic month for the market, for individual stocks. Now we've had some weakness in February. It's all part of the grand game. I don't see anything that's like outrageous or stands out as being like overly great or overly terrible. But it's time to let's zoom in and see what's going on with the indexes and with the internals. Most of what I'm going to tell you, or basically like everything I'm going to tell you, is stuff that I've been telling Lever Brothers subscribers over the last few weeks, few months. Just going to kind of rehash here and put it all into one video. All right, so first I'm going to look at the S&P 500, then I'm going to go look at some breadth readings. All right, so here is the S&P 500. What we have here is what I've been telling Lever Brothers subscribers is that the market simply has neutralized. It's not trending up. It's not, the downtrend has been neutralized. It's just neutral. It's not, there's no directional momentum as far as the overall goes. You see prices right here around 4,000, which is completely unchanged from since last spring. I could do something like this, draw a line here and say, hey, there was resistance there, there was some resistance there, support there, support there. So I could still make a case, the bear's case, that we have a large topping pattern forming, we have a rising wedge within the right side of that, and eventually this will break down. You could make that case, or you could just say, hey, we've neutralized long enough. Let me delete that. We've neutralized long enough that you could like box in a majority of the data points here and just say, hey, we're neutral. There's no directional momentum. You can make a case either way. We're not going up. We're not going down. We're just neutral. Okay. Either way works. I do know that the trading ideas that were offered during rate here were the best trading ideas we've had since back over here. It's literally the best trading we've had in 18 months. Now things have softened the last couple of weeks. Again, it's neutral. The market got above its 50-week moving average. Now it's below. It's trading in a rising wedge. You can make a case either way. I don't think it would be wise to dig your feet in and make a strong case either way. So I'm calling the market neutral right here. Double bottom at 3,600. Higher high. We made a higher low here and a higher high. That's great, but we're still trading in a rising wedge that has bearish implications. So again, I'm calling it neutral. All right, let's move on to some breadth reading. All right, so we're going to zip through these. So this is the S&P 500 up top versus the 5-day moving average of the NYSE AD line. Divergences, as you can see, call lots of turning points both at the top and at the bottom. So in January, market goes up. It was a fantastic month, as I said. The trading ideas offered here were the best we've had in 18 months. But as the month went on, you could see that we had lower prints in the NYSE AD line. Okay, lower print there and lower print there. So as it was going on, advancers were beating decliners by a smaller amount. Now, you never know how much of a pullback we're going to get, because let's come over here and change the color. Like there was a divergence there, right there. But in that case, what you had is market simply just moved sideways for a couple weeks and popped again to a new high. Same thing happened over here where we had a divergence there, and what happened? The market actually went sideways for a few days, popped to a new high, and then came back down. So when you start getting a divergence like this, you don't know if it's going to lead to just some sideways movement like this, or if it's going to actually lead to a legit pullback. Either way, you got to manage trades wisely and just be open-minded. We might get a week or two of softness. We might get a legit pullback. You don't know, but the divergence does tell us that something is probably going to happen. Okay, same chart, but with the NASDAQ, the reading is exactly the same, so I don't need to go through it. We had a divergence. We had the market pushed to a higher high. We had lower highs over here. At first, the market simply moved sideways. Now we're pulling back. It's very normal stuff. Ideally, we'd get a positive divergence. We get something like this, a lower low, higher high, or higher low there, and then that helps reverse the market. So we knew at the end of January with the divergence that the good times over here during January were not going to last. We knew there was going to be some weakness in February. We didn't know how long or how much of a pullback we'd get, but we knew it was going to come. That's what we told Levitt Brothers subscribers, that, hey, take your foot off the accelerator. Things are going to slow down here. All right, here is the NYSE. This is the day-to-day prints. One thing I want to talk about is that when the market is weak, you get extreme prints. Okay, so we got a lot of extreme prints down here below 2000, below negative 2000. We got a lot of extreme prints right here. So the reason why this happens is because when the market is weak, and I should say, like, you got a lot of high prints over here too. When you're in a downtrend, when the market is weak, good days are really good and bad days are really bad. The reason is because the pendulum just swings far from one side to the other. You have like a fantastic day followed by an actually horrendous day. But in an uptrend, when the market is healthy, good days are good and bad days are just bad, and like you don't get extreme prints. So you notice that over here we didn't get any extreme prints. We haven't gotten an extreme print in like almost 3 months. And then we had very few upside extreme prints over here. Okay, that was a good sign. That told us that the market was very healthy over here. But yesterday we got an extreme print over here. So that's something to keep a watch on, okay? Because again, if the market is healthy, good days are good, bad days are bad. But if the market is not healthy, good days are fantastic, bad days are horrendous. You get a lot more extreme prints when the market is in bad shape. So if we're getting extreme prints, that kind of implies what kind of condition the market's in. All right, here is the breadth thrust indicator. It's the total volume it's the advancing volume at the NYSE versus total volume. So I just talked about the advanced decline line, which lets all stocks talk equally. It doesn't matter if you're Apple or some little company that's 500 million, all stocks have the exact same say. When we talk about advancing volume versus total volume, we're letting the higher volume stocks do more of the talking. It just kind of gives you a little bit of not a better read, but just a different read. Divergences work the exact same way. So in January, the market pressed higher and higher and higher. We got a lot of great trades off, but advancing volume relative to total volume was declining. It just told you that, when the market did this, we got this high of a print. Market came back down and then shot up again. And what happened? We had a lower print here. So like less volume was going into advancing issues. There was a little bit of a beneath the surface internal reading that told us the market was not being fully supported and we should be looking for at least some softness and maybe a pullback. And that's what we're getting right now. All right, let's move on for a few more. This is going to be up top. The blue line is the S&P 500. Down below is the 5-day moving average of 5-day highs. Okay, hitting a 5-day high is not a high bar to eclipse, so it's something we kind of track on a rolling basis. When the market moved up here, we had this many stocks printing a 5-day high. Then the market falls and rallies again. Market prints a brand new high up here. And what do we have? We have less stocks are printing a 5-day high. Okay, so even though the market was at a 5-day high, heck, it was at a multi-month high, less individual stocks were trading at a 5-day high. That told us internally there was some weakness setting in, and we were probably going to get some weakness. Now, again, we don't know if weakness means flat trading or if it means a move down. It does mean be careful going long because it's not going to, the market isn't fully supported. We've gotten this before. There was divergences. There was divergence right in here, and you can see the market fell. Over here, we had a slight lower low, and we had a higher low over here, which told us there was going to be a turn there. So ideally, we get a positive divergence. We'll see what turns out. But in any case, Levitt Brothers subscribers were alerted at the end of January, beginning of February, that internally the market was weakening and probably we weren't going to have a continuation of January going forward. Next chart, same situation, but we're using 1-month highs instead of 5-day highs. Same thing played out. We got higher high here, lower high here, and what happens? The market moves sideways and then move down. Okay, so just little breath readings that tell us, is the market doing well? Is it likely to continue? And during most of January, we were told it's fine, keep going. But as the month went on, we were told, hey, this run is no longer supported. Next up, we have a Russell. Up top is the S&P 500. Down below is a 5-day moving average of Russell 3000 stocks above their 5-day moving average. Okay, so instead of looking at a 5-day high, we're just looking for stocks above their 5-day moving average. Again, not a high bar to get over. Market moving up, indicator moving down, and you can see what happened. So market moves like this. So we come out of a base here and move up, and we get a lot of stocks are above their 5-day moving average. Market dips and then recovers all the way up here. You'd think after this kind of a run, let me delete that. You'd think after this kind of a run, most stocks would be able to get above their 5-day moving average, but actually there were less stocks above their 5-day moving average over here than over here. So it told you that participation was waning, not everything was participating, probably going to have some weakness, and that's exactly what has set in. This is what we told Levitt Brothers subscribers end of January, beginning of February. Next one, we're looking at same situation, except we're looking at 20-day moving averages, stocks above their 20-day moving average. The percentage flattened out, which is perfectly fine. Okay, once it gets up to about 80%, there's always going to be laggards. So once it gets up to about 80%, you're not going to have prints too much higher than that. But I find what was telling was that we had a move down here and then a recovery, and that was coupled with a move down here, but then instead of recovering, there was like continued deterioration over here. So even though the market bounced over here, and that was a pretty decent bounce, there was no bounce over here, which told you that a lot of stocks dropped below their 20 when the market corrected there. But then when the market rebounded, those stocks did not recover. It just kind of told you, again, internally the market was weakening. Okay, one more chart. This is the S&P 500 versus the 10-day yield. It's pretty obvious that there is a inverse correlation between these two. So when the 10-year yield is moving up, the market moves down. When the 10-year yield moves up, the market moves down. And at the beginning of February, I was warning people at Levitt Brothers that, hey, it looks like the 10-year is going to turn around here, or the yield was going to turn around here, and that's going to be a headwind that the market's going to have to deal with. And sure enough, we got some softness at first as the market moved sideways, and now we're getting a move down. Okay, so I view everything that's taken place has been fairly normal. We've had a lot of good trade. We had some spectacular trades in January. It was the best month in 18 months as far as trading goes. So while there was a bull market in a lot of stocks, the indexes were actually just simply neutral. Okay, they're not moving up, they're not moving down. There's no directional momentum in either way. And then the internals told us market was probably going to weaken in February, which is exactly what's going to happen. So from a trading standpoint, there's not a whole lot to do right now. We need more information for the market. It's got to kind of show a few more cards before we get aggressive again. So that's kind of what's going on. Index is neutral. Stocks are starting to neutralize. Internals have turned down. We need more information. Are they going to firm and move up and give us some sort of indication that there's actually some strength beneath the surface, or are they going to continue to deteriorate and lead us to, another leg down? So as of right now, I've neutralized, and I'm just not really excited about playing anything right now. I want more information before I get excited about the next round of trades. All right, hope you got something out of this. We'll see you next time.